More and more companies are having employees work from home. Companies like ServiceNow can really take advantage of this situation. But you may have missed the boat because ServiceNow has gone up 5,000% in the past 10 years. Let's run a discounted cash flow model on this company and figure out whether it's a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing ServiceNow stock by analyzing their financial ratios and dissecting their financial statements so we can determine if the stock is a buy or a sell. ServiceNow develops a cloud computing platform to help companies manage digital workflows. It helps businesses manage projects. It can also streamline customer interaction. Let's get started with the model. This is a big company, 93.7 billion market cap, and they're trading at $480 a share, and they have 195 million shares outstanding. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. If a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things unless it takes some cash off its balance sheet or goes into debt. This company has positive and growing free cash flow each year, which looks really good. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have negative net income in 3 of the 4 years. And their revenue almost tripled from 2016 to 2019, so they're growing at a pretty rapid pace. The company had negative operating income in 2016, 17, and 18. That's why they had negative net income. And the only reason they had a big net income in 2019 was from this $500 million of deferred taxes. Let me show you in a statement of cash flows this information. It's a lot easier to see. I like to look at operating cash flow because I think that's a better indicator of a company's financial health than net income. Because the way you calculate operating cash flow, you start with net income, then you add back the non-cash items from the income statement. You also adjust for changes in working capital. What brought down their net income so much was the stock-based compensation, which is a non-cash item. So stock-based compensation is an expense on the income statement. SBC is hidden. You don't actually see the line item on the income statement. It's within the expense category. So SBC is a way of paying employees with equity. This dilutes current shareholders. Lots of startups use SBC and they give employees stock options in addition to the salary. So you can see each year they had pretty healthy free cash flow even though they had negative net income, because when you give stock options it doesn't cost the company any money, and they had deferred taxes of negative $575 million in 2019. These are taxes the company will eventually pay. Let's look at a capital structure. $700 million of debt, $2.1 billion of equity. They pay 4.5% interest on their debt, and the weight of debt is 25%, which means they're 75% equity. Cost of equity is 12%. To calculate cost of equity, we use the capital asset pricing model, and part of the CAPM formula is the beta. That's how volatile the stock is relative to the market, and their beta is 1.27, so the stock is a little more volatile than the market. Their WACC is 10.22%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $72 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $54 billion. We divide that by 195 million shares. And we get a calculated stock price of $279. They're trading at $480, so they're trading at a 72% premium. It's a sell according to the model. Simply Wall Street has a stock at $451, so they're also saying the stock is overvalued, just not as much as me. I used a pretty aggressive model for this company. I assumed significant growth because that's what other analysts predicted, and that seems to be the trend of the company. But even using a model with significant growth, I didn't come anywhere near simply Wall Street's valuation. Let's see where the stock has been trading the past few years. So the stock was below $200 in 2015, but it's really shot up the past 6 months. So I think the stock's going to do really well, but it seems overvalued, but that doesn't mean the stock price can't go up. The changes in the stock price are due to supply and demand of the market, not due to the company's financial information. If you invested $100 in this company in 2014, you'd have 4 times that amount at the end of 2019, much more than the S&P and New York Stock Exchange. This company has never paid a dividend and does not plan to pay dividends in the future. If you invested $10,000 in this company 10 years ago, you'd have almost $500,000 today. Let's look at their financial ratios. The average PE in the market is 17, the median is 15.2. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 149, so much higher, much worse than the average and median. Average price to sales is 4.7, the median is 2.0. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 27.1, also much worse than the average and median. Average price to book is 4.8, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 44, which is much higher than the median and average. Equity is assets minus liabilities on the balance sheet. The average interest coverage ratio is 12.6, the median is 3.9. Interest coverage ratio is EBIT over interest expense, so they can just cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. The average ROE is 13%, the median is 12%. ROE is net income over equity. They're at 29%, so they do provide a great value to their equity holders. Average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities, so they can almost cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios is to compare them to similar companies. I've done videos on Autodesk, Salesforce, Citrix, Datadog, Intuit, Kinaxis, Mitek, Mogo, Real Matters, Texas, and The Trade Desk, all in the same industry as ServiceNow. And if ServiceNow has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're much worse in all the price multiples, price to earnings, price to sales, price to book. They're doing worse in current ratio, they're just at 1. ROE, they're doing much better than average at 29%, average is 8%. They're average in debt at 25%. They're doing much better in market cap, they're the second largest company in this group. And they don't pay a dividend similar to most companies in this industry. So to summarize, I have them trading at a 72% premium. Their ratios and financials look a bit weak. So let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.